Hi, everyone. Today's quick conversation is on insurance companies sending letters, just like you see on your screen, to clients who have standalone long-term care insurance where they're raising the rates. People don't realize the rates for long-term care insurance typically are not guaranteed. That means that if an insurance carrier can demonstrate to their state insurance commission that there's been a huge rush of claims, for example, that's causing them to be unprofitable in a certain block of business, they can apply to have a rate increase. And that's what this is doing. It's notifying an in-force policyholder that they are going to have this increase in premium. Ironically, this particular carrier did a great job managing this. Their increases have been less than what market is, and they were way later to do that. So ironic that I'm using this as an example, but let me just show you here what we have going on. After the letter gets through the normal boilerplate stuff, it goes through and it gives specific information about your client's policy, about what they have and what they can do about it if they don't want to pay the increased premium. So you'll see here, it goes through in this block here, all the things that the client already has. They have a policy that has a lifetime benefit. Wow, those are awesome. Really difficult to want to get rid of that. They're very hard to come by nowadays. The daily benefit amount that they have, which they usually state in terms of a daily day, not a month, not a year, but this one is $614 per day. Very robust policy with an elimination period of 90 days. 90 days is the time between when you would receive, put in the claim and receive your first check. This is the part that's really killing the insurance carriers is the compound inflation. So basically, this client probably bought, let's say, a $300 a day benefit, and then it compounded by 5% to get them to the point where now it's $614 a day. The old premium, meaning the premium they were paying and the date that they received this letter, was $285 per month. And then they're stating what the new premium is going to be. It's going to go up to $314 per month. If you're trying to do the math in your head, don't bother. It's a premium increase of about 9.99%. Why they chose 9.99 and not 10%, I'll never know, but it is what it is. And the effective date of this new premium is going to be December 26th, at the end of 2024 in this example. The irony is the day after the holiday is when you're getting a premium increase. So basically what happened was in this one, you'll see earlier on that they applied for 126% increase with the state of New Jersey. The state of New Jersey granted them a 33% increase allowance, and they're moving it to the 9.9%. Okay, so the effective date of the new premium, meaning it's going to have like a step up here in 2025, will be $345 per month. So they're doing this in two stages. So the question then comes to you, the advisor, that's being posed from the insurance carrier to your client is, do you want to keep on this path that with the premium increases, or do you want to elect an option to pivot? So this is where the clients usually reach out to us. They say, what should I do? And you can see here, they've laid out a couple of options that I'll go through. The first is just the reduced benefit period. Remember, the benefit period is how long this insurance is going to last for. I told you earlier that the benefit period on this particular policy was a lifetime benefit. So what they're allowing you to do in this example, if you check this box, is change my lifetime benefit period to 6 years. The new monthly premium will change to $283 on the December 26th date that I gave you, and then we'll have a second ratchet up in 2025 to $311. So you could do that. You just shorten the benefit period from lifetime to 6 years. Which clients would this appeal to if they felt the need to lower the premiums? An older client that maybe had a little bit less life expectancy where they wouldn't need a lifetime benefit. Okay, you can see here in the small print, they'll say other benefit options available are 3 years. And basically you would just have to go to get a quote from the insurance company for that. Okay, the second option is just to reduce the daily benefit amount here. And it's you'll see it's the abbreviated DBA. So you'll change, in this example, you'll change your current DBA from the 614, which you saw on that last page, to 583. And then the new monthly premium for that would change to 298 next year, and then the following year would go up to 328 per month. Or you could change your current DBA from the 614 to 552. That you could see is even lower. That would lower your premiums to 283 next year, and then the year after 311. Now, what you're going to start to notice is that even though the premiums are being decreased, by what amount? So you can see here from 298 to 283, you're talking about less than $15 or around $15 per month. Is it really worth it for our particular client that we have? Now, you could do things like they have extend the elimination period. That's the maximum, though, for this policy. So they say, even though it could be an option with other people that we're offering this to, it's not an option for you. And the last one is reduce or remove the inflation protection rider. This is, remember, where most of the insurance companies are taking a bath. So they can move it from what's called 5% compound to 5% simple. And all the advisors on this, watching this video, you know the difference between compound and simple. And you can see then it moves the premium down accordingly. Or you can remove it all together. And this is interesting. In removing it all together, you can see that the new premium would change to 165 in 2024 and then go up to 182. So you can see how much, just by that lower premium increase or decrease, that they look at this being the ball and chain around them for this particular policy. They would love for you to get rid of that inflation rider. Who should get rid of this inflation rider? Again, I think it's an age thing, meaning that if the current client is older, let's say in their mid-80s, and they have less of a runway on their mortality, you might be able to do this. Having said that, there's no way that anyone could go back into the marketplace and get this policy if they kept it as is and just accepted the premium increases. So there's not going to be a situation where you go out and you try to repurchase this policy, especially for an older insured, and get like a favorable premium difference, meaning a lower premium for your client. Anyway, I hope that's helpful. I know this has been a little bit of a maze in this particular type of insurance, but if you have any questions, just reach out to me. Thanks and have a great day.